I'm staying put because I love the cash flow. I love the loan terms. I initially had planned to refi and pull capital back, around this point. And I could still do that, but at this point, why? Like it's a cash cow, and at some point, I may take out a supplemental loan, which is offered through my lender. If I need the capital to invest elsewhere, but with 30% cash on cash returns, why? It covers all of our personal expenses and then some, and it lets me sleep well at night. So.
Would you like to turn vacant units into cash and earn up to 3 times more per door without having to do any extra work yourself? We offer fully managed short-term rental solutions for multifamily investors. Go to managedbylux.com for more information.
Hey, this is John Bell
and Julian Sage,
and welcome to the Multifamily Success Stories podcast. This is a show where we talk to multifamily investors about their journeys and starting and growing their real estate empires.
Our goal is that you'll be able to walk away not only inspired, but with practical information to help you in your real estate journey.
Since we are a new show, please go over to iTunes and leave us a review and let us know what you enjoy.
And if you haven't done so already, go on over to our Facebook group, the Multifamily Success Network, to connect with the community. Hey, what is going on, Dealmakers? Julian here, and in this episode, I had the special honor of speaking with Candace Pilgrim, the co-founder of Astra Equity, a real estate investment firm with 154 doors and $11 million of assets under management. In this episode, Candace shares her experience of starting and scaling her first business of electronics wholesaling, why she switched to multifamily investing, the lessons and numbers with her first 40-door apartment, as well as how she built her JV team of 3 members to be able to help her scale, how you can actually go about finding those JV partners, some really good advice around there as well. Of course, if you like my show notes for this episode, go to multifsuccess.com/EP25, or if you like my show notes sent directly to your inbox every week, then go to multifsuccess.com/show notes. With all that being said, on to this week's conversation. Hey, welcome back, Dealmakers, to another episode of Multifamily Success Stories. In this episode, I have the special honor of speaking with Candace Pilgrim. Candace, would you please introduce yourself to the Dealmaker community, let them know who you are, and what inspired you to get into multifamily investing?
Yeah, absolutely. First of all, thanks so much for having me. I'm happy to join you today. I guess I'll start kind of from the beginning of my professional career. I had a background in science, so I have degrees in microbiology and biochemistry. From there, that's what brought me to Birmingham, Alabama. I actually moved to Birmingham, which is where I currently reside, to work on a PhD in immunology. I loved scientific research. That was kind of my first passion, I guess. But realized once I got into that program, it wasn't the research that I didn't love, but it was the environment and the highly political nature of scientific research and grant funding, and just wasn't what I wanted to do. I wanted to work for myself. So I left that PhD program. This was back in 2013. I started an electronics wholesale company. So once I had kind of hit our magical income goal from that company, my husband quit his job to help. And at that point, we were off to the races with that business, and that business did very well, mainly because we didn't have any competition. I'd like to say it was because of my entrepreneurial spirit or something, but wasn't necessarily the case. It was some luck wrapped in there, and also just a lot of hard work on my part and my husband's part. So we did well with that business for years, and by around 2017. I was looking for a place to just park some capital that we had accrued from that electronics business. I no longer needed to reinvest into that business at that point. So we were looking to diversify beyond the stock market. Similar path that so many others take. They find real estate that way. And same for me. I landed on real estate because it was much more controllable and easier to force appreciation and just a tangible asset, all the reasons you hear. So I had set out in 2017 to really learn the business, learn the different asset classes, kind of decide which direction I wanted to go there. So like everyone else, initially started with single family, but after our first 2 single family homes, the Burr strategy, if you're familiar, after 2, we realized it would take us way too long to scale to where we needed to go, or our goal, I guess, for financial freedom. It would just take too long. So multifamily seemed like a much better, more scalable path to take. So since there's a bit of a learning curve that comes along with multifamily investing, I started passively. So I invested with 3 different deal sponsors first in 2018 that I had met through conferences. I'd formed relationships and kept in touch with some of these deal sponsors I'd met. Invested with 3 different sponsors, and those deals went well or are still going well. But throughout that process of really having to learn the business, because I like to really understand what I invest in, like everyone else. So I had to learn the underwriting. I had to learn that, how to vet a sponsor, how to vet a deal, how these business plans work on these larger assets. And I really just kind of fell in love with the process and the operations side of it. So, I'd set out to one day be active as well, full time, and step away from that electronics wholesale business and into multifamily operations full time. So that was my goal, started working towards it. Our first active multifamily deal was a 96 unit property in Birmingham. That was a joint venture deal with 2 others. I've since exited that deal, so that's no longer a part of my assets under management. But my first real deal that taught me everything that I know was a 40 unit property here in Birmingham, super heavy lift. That was in mid 2019. And from there, we just kept acquiring assets. So mainly smaller, 20 unit, 30 unit, 40 units, 24 units. So we've mainly played in the smaller space, I guess. But going forward, we're definitely seeking 75 plus unit assets. And also our last 3 deals have been with Astra equity. So after doing 3 deals as a team with my 3 joint venture partners, we decided to make it official. We work great together, great team dynamic. So we're officially Astra Equity and pursuing deals exclusively going forward.
So I want to go back a little bit towards the beginning. I mean, that first business that you really took off was the electronics wholesaling business. What were some of the things that you learned from scaling that business up, and if you could kind of share like what size or like what type of revenue were you bringing in before leaving that job or that business?
Yeah, so we topped out just north of 7 million annual revenue. So, we decent size operation, I guess. We were the largest wholesaler of electronics or of iPhones mainly at that point. When we reached that revenue, we had kind of honed in and we're focusing on Apple products because there's a big resale industry for that space, and they hold, iPhones hold their value well, and iPads and MacBooks. So we had focused on that space. When we hit the 7 million plus revenue at that point, we were the largest third-party wholesaler in Alabama. So the one thing I would say that I could bring over from that business to multifamily real estate is the networking component, because that's the one way I was able to build that electronics business. When we started out, I traveled to all the different major cities in the Southeast. We traveled to Nashville once a week, Memphis once a week, Jackson once a week, Atlanta once a week. And I basically just got in the face of all of these other mom and pop cell phone stores. I gave them my price list. I didn't just make a phone call or an email. I made sure to introduce myself face to face, hand them a price list, say, if you ever have overstock, please call me. And I kept following up and built those relationships over the years with these vendors. And that's ultimately what led to the success and, the revenue that we were ultimately able to achieve. It was all about the relationships, and multifamily is the same way. You build relationships over time. Don't expect it to happen overnight. And eventually it all starts paying off.
So you were working in this wholesale business as it was a B2B instead of B2C. So you weren't like listing the iPhones and iPads like on eBay or something. And
it was 100% B2B. We were wholesale only, no retail.
Okay. So networking, you say, was the biggest thing, but I mean that sounds like there's got to be a lot of logistics around managing all these different businesses and finding the best products. What were some of the biggest challenges that you saw with scaling that electronics wholesaling business?
The biggest challenge with any business really was the competition. The competition became more and more fierce over the years. As I mentioned early on, we didn't have a ton of competition. So we were able to, have a decent profit margin, very low risk. Well, I would say high risk, high return type investment, just because there's always that risk of if we were holding 50,000 worth of iPhones and the price, it's like the stock market. The price in the wholesale industry was constantly up, down, up, down. So, if the price dropped $50 per unit and we were sitting on 100 units, well, that was a loss. And it's not one that can be easily recouped because the price likely won't go back up, especially with new models constantly coming out and supply and demand imbalances. So there was always that risk there in that business. And I guess for me, it was just a matter of the relationships I had built with the vendors. I would take care of my vendors, even if it meant I would lose a little bit of money on a certain sale. And that kept them coming back to me and selling to me, even though the competition was becoming more and more fierce in that industry. I was able to, now don't get me wrong, I did have to shrink our profit margins a bit. Over the years, our profit margins would shrink a bit. But at the same time, I knew my vendors would keep coming back to me, even if it meant maybe selling their product for $10 less a unit. They knew that I would take care of them, and that relationship was what mattered. So I guess that's why I say I could bring that over to the multifamily space, because relationships are everything in that business as well.
What what type of were you able to measure like an ROI? Like if you got some type of deal from that, it would transfer over to X amount of ROI, and like how does that compare to the amount of time and resources that you invested into that wholesaling business versus a multifamily deal?
It's hard to measure like an ROI simply because we were flipping and turning over constantly daily. I mean, we would ship our inventory at least twice a week, sometimes even 3 or 4 times a week. So it was a matter of, buy a wholesale bulk lot one day and sell it the next day. So it was constant turnover of capital. It always varied based on how quickly we would get paid for, a shipment based on the customer we were selling to. But hard to measure ROI. But if I did actually go back and try to measure ROI, it would have been an insane amount just because of how quickly we were able to turn over the inventory. But differences with that business and multifamily investing, you hear work on your business, not in your business. It was impossible for me not to work in the business, in the electronics wholesale business, because those vendors relied on the relationship they had with me. I could not outsource that to someone else and know that they would keep coming back to that person because they liked dealing with me. I was their initial contact. They knew I would take care of them. And so maybe as a little bit of a control thing, because I was afraid I would lose the vendors if I handed that off. And, maybe if I were to do things differently, I would change course a little bit. But I guess the main difference is with multifamily investing, I feel like I can outsource much easier, and I can take a step back and I can see that path to actual passive or much more passive income and being able to enjoy life a little bit more.
And can you talk about that first deal? You said that first deal was a 40 unit, was it?
Technically, the first deal was a 96, but yeah, we'll call it the 40 unit because that's the deal that was really 100% mine and my husband's, and that's the deal that I learned everything from.
Okay. Can you share about how you found this deal, and what was it like before you actually invested into that?
Yeah, absolutely. So I initially was introduced to this deal via LoopNet, which everyone says that's where deals go to die. I didn't buy it from that seller, so it's kind of a long story, but I saw the deal on LoopNet originally. Of course, my offer came in much lower than they were asking, but I submitted an LOI anyway. I had offered $33,000 per unit, very heavy lift, so keep that in mind. This was actually a nice, B-class area, but it needed a lot of work, low occupancy. They really just run the property into the ground. So I offered 33 a door. They countered 40 a door. We couldn't come to an agreement. So I walked away and forgot all about the property and didn't think I would get it. And then about 3 months later or so, I actually received a call from a broker friend of mine. This broker also acquires his own deals. Him and his partner, they buy deals as well as broker deals. Well, he called me and he said he knew I had been bidding on this property previously, and he wanted to let me know that he was able to get it under contract as part of a larger portfolio of over 200 units, same seller. And his business model is very turnkey. Like, he doesn't like doing a lot of work to the properties. He really just likes to cash flow, and he's not really a value add type investor. And because this 140 unit property needed so much work and all the other properties in the portfolio were stabilized, we worked out a win-win where he flipped the 40 unit to me. As soon as he closed, we were already under contract contingent on the closing of the portfolio. And as soon as he closed the portfolio, he flipped the 40 unit to me because he didn't want to do all the work. So it worked out. I ended up getting it for the 33 a door I originally offered. I just bought it from a different seller technically.
And how much did you have to put into it?
We put about 400,000 into it, so about 10 a door.
Okay. And what type of like training or experience did you have prior to this? Did you just go in like no experience, just like I'm gonna wing it, or did you have a little bit of training or something to help you?
Well, not really formal experience per se, but I attended a lot of conferences, read a lot of books. I had unofficial mentors that helped me in that initial process that made sure that I wasn't missing anything in the underwriting. So, I had people to call on. It's not like I was completely blind, but for me, the best way to learn is to do. So rather than reading and learning and passive investing, and, I just wanted to jump in and do it. And for me, using my own capital was the best way because I wasn't risking other people's money or wasn't risking investor capital or joint venture partner capital. And plus, with it being a heavy lift deal, at 33 a door, I mean, the rents were at the time of acquisition mid 600s with potential, 800. So I knew with the numbers, it's hard to mess that up. Like even if things went horribly wrong, I could at least sell it for, what I bought it for or more. So I thought it would be a great learning opportunity with decently low risk.
And what was that? What were some of the major challenges that you faced with that first deal?
Just I guess learning all the little intricacies of the transaction process. There's just so much that you can only learn by doing it. You can't really learn by reading a book, and there were just a lot of those little things, little mistakes. I think the biggest challenge we faced with that deal was with contractors. We went through 4 or 5 different GC firms and ultimately ended up subbing everything out ourselves because we just weren't happy with the quality of work and the timeline that we were getting from some of the GCs that we had brought on. So once we started subbing everything out, I only lived 20 minutes from the property. So it was kind of easy for me to do that. It was a lot more work on my part having to project manage, but we saw significant savings, and not only from a rehab budget standpoint, but from a time standpoint, just getting these units turned more quickly and, basically filling them up, which leads to income. So that was the biggest challenge. I learned the hard way to always have like a good cushion in a rehab budget, especially for older properties, 70s, 80s. There's going to be surprises. So make sure you have a contingency built in.
About how much did you have kind of tucked away for, these types of situations happening?
We didn't really have like a per se contingency. It's kind of hard to answer that question directly, simply because when we started out, we had a rehab budget of $350,000. But after we were under contract, after we had our loan approval, we changed our business plan a little bit, and we decided to add laundry hookups, washer and dryer hookups to 20 of the units. Our property manager recommended that would be a good ROI on that, basically, because we can increase the rents for that. So because we added that, obviously we blew through our budget. So it's kind of hard to say like how much would we have gone over without doing that, because each unit was a little bit different in the floor plan and what we had to do to add the hookups. Like I said, we're at about 400,000 right now. So 10,000 a door, but we still have 7 units that haven't turned and may not turn. We've been able to increase the rents, and the residents have just wanted to stay put. So we didn't really have a contingency, but at the same time, we had ample personal reserves, and this was our, self-funded, self-owned deal. And we knew at any time we could just put more money into the deal.
With that first GC, what were some of the, if you could go back, what were some of those indicators or some of those first things that maybe you would have not worked with them, or subcontracted yourself or found a different GC, if from what you know now?
I think that it would have been hard with the first GC. It would have been hard to recognize the potential for failure or for disappointment up front. There are certain things I could have done to have made it go a little bit more smoothly. But I mean, at the end of the day, he was recommended to me by someone else. He had ample experience in the space. We had a lot of mutual friends. So, I thought we were good to go there. But I will say that going back, I wish I would have been much more clear about my expectations up front. I've learned, don't have just a simple scope of work, have a very detailed scope of work. Like, make sure the GC knows exactly what you expect before they ever begin work. Because, ultimately it has to be a win-win situation. The GC has to be happy with the profit they're making from the deal as well. And I think that was one of the issues when we set out to have this GC bid. And they came back with a number much too high. We countered back, well, no, we need it at this number or it's not going to be worth it to us. And of course the GC took the job, but looking back, maybe it wasn't worth it for that GC to take the job at that price, because ultimately what happened was they pulled back on quality. They put their worst guys on the job. They tried to cut corners, and we saw it pretty quick. They only did 7 units for us, the first GC. So we quickly saw the quality was not what we expected and moved in another direction. But, breakups with GCs are kind of painful at times. There's open balances that have to be reconciled and all. So it's still not fun. It'd be much better off to just be clear up front with your expectations to make sure that at the price point you're agreeing on, that GC, will meet your expectations.
And what are some tips that you have for when you do have to make that pivot and go the subcontractor route? What would you tell yourself, what you know now?
Yeah, it really just depends how much time you have, because like I said, the subcontractor route, it works for us because we're 20 minutes from the property. My husband is full-time multifamily as well. So he handles most of that now with overseeing the contractors and, making the scopes of work and making sure, checking the quality and lining everyone up. So we have that available to us. But for a lot of people, that's not an option. Subbing out is definitely not an option. It is definitely a time commitment. And some people would say that your time would be better spent elsewhere. What's the highest and best use of your time? It may not be that. So it's definitely not a good fit for everyone. It's a good fit for us just because we know our subs are good. We have a lot of contacts in the market and we know that our subs do good work. We just couldn't find that in a GC, which is frustrating. You would think they use a lot of the same subs, but wasn't necessarily the case. So my advice would just be, if you're local, if you have someone that can maybe project manage for you and that's an option, then I absolutely recommend going that route. You have a lot more control over the investment that way.
And this first deal that you took on in 2018, was it?
2019 for the 40 unit we closed in 2019.
You closed in 2019, and this project's still underway.
Correct. We're stabilized now, so we've turned 33 out of 40 units. Might be 34 now. I think we just had one complete. But yeah, with that project, even though we still have 6 or 7 left to renovate, we've already increased the rents on the majority of those units, and the residents have just chosen to stay in their unrenovated unit. So at this point, we're stabilized. We've been at 100% occupancy for some time, other than this one that we're turning right now. So yeah, definitely the project is complete. At this point, I could easily sell and meet pro forma, and the business plan is complete. I just don't plan to sell because I like the cash flow.
And can you talk about the cash flow? Like what did you anticipate going into it, and did after all your renovations and how much you actually had to invest in it, did it meet those expectations or exceed it?
Definitely has exceeded it for several reasons, some of which are luck and some of which are, good asset and property management. So going into the deal, we invested around $350,000 into that deal. And then of course we came out of pocket a little bit more. So all in, I would say about $400,000, all in investment. Right now we're cash flowing about $12,000 a month. So once our interest only burns off, it'll be $8,000 or $9,000 a month. So one thing that allowed us to cash flow so amazingly was a loan modification. We were able, during COVID, I reached out to my local bank lender and requested a loan modification. So we had previously a 5.5% interest rate on the loan. And, in early 2019, that was a decent rate, especially for a heavy lift project like this. Now rates have obviously dropped a lot since then. So we requested a loan modification. The lender granted it. So we went from a 5.5% to a 3.5% interest rate. So immediate $2,000 a month added cash flow just from that interest rate adjustment. And then the lender also extended our term. So we now have a 10-year fixed rate term, whereas we had a 5-year before plus a 18-month interest only. It was basically a 6.5-year term before. So I'm staying put because I love the cash flow. I love the loan terms. I initially had planned to refi and pull capital back, around this point. And I could still do that, but at this point, why? Like it's a cash cow, and at some point, I may take out a supplemental loan, which is offered through my lender. If I need the capital to invest elsewhere, but with 30% cash on cash returns, why? It covers all of our personal expenses and then some, and it lets me sleep well at night. So, but keep in mind, I want to mention, sometimes people are like 30% cash on cash. There's no way, that's unheard of. But I also want to mention, first of all, this is a self-funded deal. It's not a 70-30 split. There's not 30% sweat equity going to general partners. So that in itself makes returns higher. I'm doing a lot of work. It's my time. It's not just my money. And then also that loan modification helped a ton. And then thirdly, I should say, we had a cable contract that was around $16,000 a year when we took over the place. We thought we were going to have 3 years left on that cable contract because it transfers to the new owner. Well, we found out that renewal never got processed by the cable company, even though it was signed. So that was like an immediate win. We were able to drop that cable contract, which was not adding, it doesn't add to our rent bump potential. So we weren't benefiting from that. So that was an immediate boost to our NOI, immediate boost to cash flow. And then finally, last but not least, the first year of owning that deal, we were negative cash flow. So, when you hear 30% cash on cash return, you have to average it out over, we might get 30+% this year, but we got 0% or minus 5% the first year. So averaged out, it's mid to upper teens, which is still good, but just wanted to, I guess, give you some context on how good those numbers might sound and what all went into it.
Now, do you think that this is just it sounds like it was a lot of really good things happening all at the same time. Do you think that maybe puts your expectation is really high for what you're looking for now, which might be a lot, maybe not as realistic as to what is currently out there, what most people are able to find and do?
Yeah, it's really funny you bring that up because my partners have reminded me of that a few times. My partners at Astra Equity. So the first few deals, especially, we were looking at, I was just like, man, 8%, 10% cash on cash returns. I'm like, why are y'all so interested in this? And I have to keep reminding myself, like, I was spoiled with the first deal. They're not all first of all, it was a high risk deal because it was so distressed. And I had to remind myself of that. But also, they're not all going to be that nice. That was a rare find. It was a great first deal for me, but yes, I do have to constantly remind myself that or readjust my expectations for future deals for sure.
And I also saw that you do a lot of LP investing. What's the reason for that, and for going the LP route and not just going all GP?
So those LP investments were mainly in 2018 when I first was starting out and wanted to learn the business and hadn't really jumped in actively yet. So I only have 3 LP investments with 3 different sponsors at the moment. And going forward, we're looking at other LP opportunities, but primarily through our solo 401k, just because we can't use solo 401k money easily for our own active deals. So we would go passive for that case, and for my husband's solo 401k as well. So we do still look for opportunities, but as you said, active is our primary preference and path right now.
And is there a reason, what would make you choose going LP versus GP?
Well, LP is kind of self-explanatory, I guess, with the passive income component. You give a check and you receive checks quarterly. You don't do any work. So I could see myself, at some point, with Astra Equity, and obviously we'd have to discuss this as a team and make a decision as a team. But at some point way into the future, we would either outsource our different roles within the business or possibly just passively invest just because eventually I want to retire. I'm still a ways from it, obviously, but passive investing is a great avenue for people who either don't have the time to be active. Like maybe you have another business or a W-2 job that takes a lot of your time, or it's also a great avenue for someone who has a lot of income in active real estate, but either wants to diversify into other markets or diversify with other sponsors, or just wants to kind of step back a little bit and just put their money to work for them and maybe not work quite as hard on sourcing and operating deals.
So those first few deals that you did you go in there with like an expectation that you were going to be really diving into the books and really learning, or was it just more like hey, I'm just going to give some money, see if this thing even works, and kind of test the waters?
A little bit of both. So yeah, my initial intention was just to invest passively before I realized I love the active side of things. I was still very active in the electronics wholesale business, so I didn't have a lot of time on my hands at that point. So I planned to just invest, diversify, outside of the stock market. And that was my initial intention. But of course, as I became more and more interested in multifamily real estate, I also became more and more involved isn't really the right word, because obviously as an LP, I'm not really involved, but I definitely took more time to review financial statements and join the quarterly webinars and ask questions and just tried to kind of peek behind the curtain, so to speak, with these larger multifamily investments.
How has your perspective changed, going from the LP side to the GP side? And are you guys also looking for LPs for your deals now?
Yeah, so we have two models primarily that we use at Astra Equity. One would be the syndication model with taking on LPs, which would really only make sense for us above 5 or 6 million acquisition price. But anything under 5 or 6 million, somewhere around in there, below, around 125 units or less in the markets we're in, we would just look to joint venture those deals. So, Astra Equity, the four of us, we all still have capital to place as well. And we have several, potential JV partners we would bring on that we already have those relationships with. We know we can work well with them. They have substantial capital to place. So we like small groups. So of course we would keep it small, only bring 1 or 2 on at most. We would all have voting rights. We would all be involved in the property management calls. So obviously we would meet SEC guidelines there, but we love the joint venture model for smaller deals where we can make it work.
And can you kind of break down, maybe for people that aren't familiar, like why would somebody go, with a syndication versus a JV?
So it really just depends how active the investor wants to be. So with a JV, all partners have to have some level of activity. So for our JV model, we actually use a local lender for smaller, sub $6 million deals. And our local lender requires anyone who owns 10% or more of the deal to sign the loan. So that right there is immediate difference with syndication. Obviously, LPs would never be signing a loan. So, that's one thing you would have to take into account. And then also with the JV model, if the investor is wanting to learn more, like obviously you can learn a little bit by being an LP, by reading financial reports or asking questions, but the JV model really allows investors to see everything that's going on. We're all on a Slack channel together for communications. We're all on the property management calls. We all make decisions together because we all have voting rights proportional to our equity share. So it's just it depends if the investor wants to be a little bit more hands-on and learn a little bit more. With the syndication model, you give a check and you receive checks and monthly updates or quarterly updates, but there's really no level of activity there. One benefit I will say that some investors really like with the syndication model is the preferred return that's offered. Typically a preferred return of 7 to 9% or so will be offered in that model, whereas the JV model, there is no pref. It's just a straight, split with no pref based on the cash flow and the percent ownership everyone has.
So you guys haven't raised any capital through syndication yet?
We have not. No, we have not syndicated yet. We've done a few of the JVs, like I mentioned, where we bring on additional capital partners, but we haven't syndicated yet. We're definitely open to that. If we find that deal that's 125 plus or 6 million plus, somewhere around in that cutoff mark where it might not make sense for us to JV, But the way we do it, when we underwrite a deal, we underwrite it for syndication first, just to compare apples to apples. We work in those fees, that pref, 70-30 split. And then what we do is we look at the total capital needed to close. And then as a team, the four of us say, well, how much do we all want to invest? Because we would invest equally. So if I wanted to invest, 100,000, and one of my partners in Astra only wanted to invest, 50,000, then at that point we would invest 50 each, because we always go with the lowest, whoever has the least capital to contribute for that given deal. So say 50,000 was the lowest one of us was going to contribute. So as a team, Astra would contribute 200,000. Well, if the total capital raise is 2 million, then we know, 1.8 million we would need to raise. Well, at that point, do we have a JV partner willing to bring 1.8, or can we achieve that with 2 JV partners? If not, we're going to syndicate, because we don't want to bring on too many JV partners. We want to keep the JV group very small, you don't want what's the expression? Too many chefs in the kitchen, or too many cooks in the kitchen. We want to make sure we can make decisions together and operate the property or the asset effectively. So, but we're definitely looking at syndication this year, and we feel like, that it'll come sooner rather than later, just because of the size of deals we're looking at now.
What type of person or what type of situation would someone be in to want to go a JV route? Because you did that first deal yourself. It was really successful. Why work in a JV partnership?
Like I said, it really depends on the amount of time or the amount of activity that you desire, how active you want to be as an investor, and then also how much control you want over that investment. So as a JV partner, you obviously have more control because you have voting rights. You have more of a say-so in when you sell. If something's going wrong with the asset, then you have more of a say-so on how to fix it. Everyone is contributing to making sure the investment is performing to expectations. So that's the main difference. And, most of our partners, we have potential partners that are interested in joint venturing, but not interested in syndication. That's the main 2 reasons. Is either they want to peek behind the curtain even more and see the inner workings of one of these deals, so they can maybe one day do it on their own, or they want more control over the investment and to be able to have a say-so in the major decisions.
Do you think that you can really scale just utilizing JV, or does it come a certain point where it's like it doesn't make sense and then you have to go to syndications?
Yeah, at some point we will, I feel like, definitely have to go to syndications. We thought it would be sooner rather than later, but surprisingly, we've actually had several, 1 million plus investors that are interested in joint venturing with us. So with that being said, with take 2 of those, that's 2 million right there in JV partner capital. And then of course, Astra has capital as well to contribute. So I guess we've kind of backtracked a little bit and said, well, maybe JVs will continue to make sense if we have these larger investors willing to step in. But yes, at some point that won't be an option. At some point we'll definitely have to syndicate and bring in the 100K investors or the 50K investors that everyone else does. And of course, we're also interested in family office relationships and private equity options as well.
What type of, when you're calculating these deals, what is the difference that you see for your returns from doing a syndication versus a JV? Is there a significant loss of potential revenue on your side if you go syndication versus JV?
No, we structure them pretty much the same. Now, obviously, in a JV, we don't have any fees built in for us, but we still structure it in such a way where Astra Equity receives a little bit bigger cut of the pie for equal dollar invested, simply because of the work we put in with sourcing the deal, due diligence, fronting the risk capital, because Astra always does that as well. So we put our money at risk. If we don't close, the JV partners don't lose anything. And then just the ongoing operations. And, I'm local, so I'm boots on the ground here for our team. And, we have to be compensated for our time too. So we do invest our own money in every deal, but we also get an extra % ownership there, similar to a syndication structure with like a 70-30 split. So for us, the returns are very close to the same. By the time you take out the preferred return and you take out the fees, it kind of levels out to the same compensation for us. And for a JV partner or a limited partner in each model, their returns are very much the same too. Sometimes with a JV, the returns are a little bit higher,
just because it's typically a little bit smaller deal, so less competition in that space. We're able to sometimes source a little bit better deal in that scenario than the 100+ units.
And when you're reaching out to one of these larger JV capital partners, what do you expect from them? Do you expect them to also be managing different aspects of the deal, or are they looking more from like a passive, just like, hey, you guys do all the work and this is going to be my return? Like, how do you structure that?
So we haven't actually reached out to anyone ourselves. I mean, all of our potential JV partners have kind of come to us through prior relationships, friends, family, relationships we've had for years, either through the electronics business for me, or, each of my partners have business backgrounds as well. So we all have contacts. It's not like we've been trying to like seek out these potential partners. So I guess I should say that first. But as far as level of activity or what role they expect to have, it's more of a consultant type role, really. It's not like they have a certain role that they have to, go out and do. It's more like we all make decisions together. So if we want to pivot and change our business plan, we would obviously get their input on that, and we would all vote on that. And then, like I mentioned before, too, anyone with greater than 10% ownership signs the loan. So that's a role in itself right there, is signing the loan. That kind of checks the box for activity, and then the voting rights as well checks the second box for being active.
So with these partners, they don't care about like actually like managing the project. That's what you guys at Astra do, and then that partner, the JV, is basically just more so for capital.
Yeah, more so. So yeah, Astra Equity does cover the day-to-day operational piece there. It's more so, like I said, a consultant, to where if if one of the JV partners had a recommendation for improvement, or if they saw something we didn't see, maybe they can give us ideas for certain things, or we get their input. And if they're interested in a certain role, we're definitely open to that. Like if they have a certain strength and can provide that to the team, then we're very flexible at allowing the JV partners to have any level of activity they desire, really.
And where do you see? I mean, it sounds like you've had a good amount of success. Where do you see this going in the future? Obviously, you're in the space, and you also have an education platform, the Multifamily Women. Can you talk about that and kind of what led you to creating that as well?
Yeah, absolutely. So Multifamily Women's Mastermind, MWM, co-founded that group with Chat Steinwald and Michelle Lopelt. So the three of us, we really just saw a need for, a women's support group within the multifamily space. So that group, we have a Facebook group, but we also have monthly meetings, and we have what we were doing in-person meetings before COVID, but that kind of messed things up a little bit. We had planned a Cabo retreat with another women's group that we were working alongside. So we definitely strive to support one another in the multifamily space, because, as you know, it's primarily men in the multifamily space. So we just want to kind of be that sounding board for other women working together and empowering one another and doing deals together. We've actually had a lot of deals result, or partnerships within the women's group result from the mastermind, which has been really cool.
And where do you see multifamily, let's say for Astra, where do you see your guys' investing strategy moving forward in the future?
So we'll continue along the path we're on now with either JV or syndication, depending on the size of the deal. So right now we're looking in primarily Birmingham, Alabama, and Huntsville, Alabama. And then we have a secondary focus on Charlotte, North Carolina. So we're going to continue looking in those three markets. We're seeking 75 plus unit deals. So anywhere from 3 million up to around 25 million is kind of where we're comfortable pursuing deals. We're looking for 1970s or newer, preferably 1980s or newer, like everyone else, B and C class assets in B class areas. Yeah, I'm sure you hear that all the time. But we're going to continue on that path and continue our growth trajectory. We've closed 2 deals in 2021 as a team. We're aiming for 3 more this year as a team. So we won't buy if it doesn't make sense. So if we don't meet the goal, that's fine. And we just want to be able to sleep well at night. We're big on the deal must cash flow day one, just because of the the point we are in the economic cycle and minimizing risk, we'll only take out long-term debt. We're avoiding bridge debt right now just because we're not sure what the market's going to look like in a year or two. And we always make sure that we have adequate reserves. So with all of that considered, that's kind of our criteria, and we're going to continue along that path and mitigate risk any way we can.
And going from a 30% return your first deal, now that you're doing these JVs, what are you typically looking for in the ballpark?
So we're looking for around 15 to 20% IRR, and around 8 to 10% cash on cash, averaged over a 5-year hold. We typically will model deals over a 5-year hold first, just to compare apples to apples. And then of course we'll, pull back and play around with business plan and possible exit strategies from there. But just based on a 5-year hold for apples to apples comparison, that's the returns that we would like to see when underwriting.
And any tips or advice for working and JV partnering? I mean, it can be challenging just having one partner sometimes, but you have four different partners?
3. So there's 4 of us total, including myself. But you hear it all the time, and it's so true. Like you need to find others that not only your visions align or your goals align, but also that your strengths complement one another, and you have very defined roles. So that's one thing that, I see a lot of people, I guess, making the mistake of is they'll jump in with a partner that maybe they're identical and they have the same strengths. And you're not really, you can work together. You can both put in capital and JV in that way, but you're not really going to benefit or grow in that scenario. So for example, in Astra, I'm the asset manager for the team. So I'm the main point of contact for property management. I handle the day-to-day tracking KPIs and reviewing financial statements and just staying on top of lease renewals and move outs, basic asset management type role. And that's what I enjoy. But then the acquisition side, which I don't necessarily enjoy, Jeremy Porto handles that. He's great at broker relations, direct marketing, transaction coordinating. He does all of that on the front end, which I really don't like. So I'm glad someone else is great at that and does that. And then we have Stuart Dukeman, which is our investor relations. He's so well spoken, and he explains things so well, and he has that business background, and just really, he's invaluable to our team, like we all are. But he's the one that handles our investor portal and answers questions for potential JV partners or investors going forward. And then finally, last but not least, Rich Trepanier, he's our construction manager. So he handles the scopes of work and the rehab, estimating rehab cost and point of contact. He owns Gage Multifamily Services out of Austin, Texas. So he brings a lot of experience to the team with his multifamily renovation experience, because that's what he does day in and day out, is value add repositions for other operators. So my strengths were easily filled by the partners. I had each thing that I did not like to do, they filled, and they do an amazing job. And our team dynamic is really just like the definition of perfection in my mind. So it's very lucky to be able to be aligned with those 3.
Do you think that you could have done as much as you've done now without your partners?
Definitely not. Nope. I could not even put into words how much they've helped me grow, not only business-wise, but just, holding me to a higher standard, because I don't want to let them down. So it's really helped me make sure I'm on my game, because if I only have myself to let down, I'm more likely to slack off. Is not the right word, because that's not in my personality. I've always been very driven and motivated by nature. But when I have 3 other partners that are super impressive and always, on their A game, I guess it helps me continue to stay on my A game as well.
And where do you recommend if there's people that they're not interested in managing different aspects of the business, or maybe they're interested in finding partners? How do you go about that?
One piece of advice I would give is definitely don't rush it with jumping in with partners. I kind of made that mistake early on with the deal I mentioned before, my 40-unit deal. And I joint ventured on that one and really just looked at the numbers of the deal and not the deal itself. And, later regretted that partnership, not necessarily the deal. But I would just say, the partners matter so much more than the deal itself, than the numbers of the deal. So you really want to make sure that you know your partners well before you jump into a deal, because it's basically like a marriage. and you want to make sure that you can work with someone else. And that's why, for example, we, as Astra Equity, closed 3 deals together and successfully operated 3 deals before we decided to, join forces as Astra, just because we wanted to make sure, even though it seemed great, you just never really know till you get in and actually, work together on a day-to-day basis. So I would just say, don't rush it with jumping in with partners. Try to keep an open mind and, maybe work with, if you think you have a couple of great partners for a deal, maybe work with them on one deal first. Don't just run out and immediately form a team and start pursuing all deals and co-branding together. And I see a lot of people do that on, in the social media universe, with co-branding themselves as a team before you've actually successfully closed a deal as a team. And it's just hard to unravel that once you get associated with someone else, if it doesn't work out. So take it slow would be my advice.
And if you could go back from scratch, what would you do differently?
So I would say I would be a little bit, let me think how to put this. When you attend all of these multifamily conferences, you hear, don't start small, jump into the 100 plus unit assets, why not go big, go big or go home, whatever they say, they preach that that's almost like it's the only way to reach success in this business. And I wish I knew starting out that it's more important to know my own personal investing criteria and goals, and don't just assume that, the road that most people take or the road that they're preaching at these conferences is the only way. They say to add value to a bigger team, learn the business that way. But ultimately, if you're bringing a deal to a sponsor, an experienced deal sponsor, say a 150 unit deal, and you have no experience, you bring that deal to a bigger sponsor, they might give you 5% of the GP for sourcing a deal, or maybe you raise a little bit of capital and sign a loan or something. They're going to give you a piece, but you're not really, it's better than nothing. Don't get me wrong. And it is the right path for some people, but you're really not going to learn the business the same way you would if you go out and buy a 40 unit asset, if you're able to do that, or if you have a capital partner that's able to do that with you. So I would just say, I wish I knew early on not to get caught up into that whole 100 plus is the only route, number of doors that you have that everyone boasts about. At the end of the day, it's about cash flow and net worth, not about number of doors. So I wish I knew, just stay focused on my why, and, don't get caught up in the ego of trying to accumulate units. And I'm not saying I did that necessarily, but I did right at the beginning before I found that 40 unit. I was trying to network with everyone I could, try to get involved in a 100 plus unit deal. And I feel like it slowed me down a little bit. If I had just bought the 40 unit first, I think I would have grown much quicker than I did trying to take the guru route, I guess.
So you're the anti-guru now?
No, and I hope I didn't come across that way, because I respect several of the gurus out there. I attended Rod Cleef conferences. Rod is an amazing person. I speak very highly of him, and I definitely don't undermine what he's doing. I think he's offering an amazing service to so many investors, and he's changed a ton of lives. I'm not officially in his coaching program, but I would still recommend it to others. And I'm a part of that ecosystem, I guess, because I've attended all the conferences. So definitely don't take that the wrong way. I think what he's doing is great, and I think it's the right path for some people. I'm just saying, don't underestimate the power of buying your own small multifamily and learning that way versus only trying to get involved in a 100 plus unit deal with a smaller role. I think you'll learn more depending on your personal investing strategy, the investor. For me, at least, I wanted to learn operations. So buying my own deal was the best way for me to learn. Maybe for someone else, it is best to go with 100 plus and have a smaller piece of a bigger pie. But for me, I just wish I had known early on that wasn't the right path for me. And I probably would have got started a little bit quicker.
And what's the best way, if anybody wants to be able to reach out with you, Candace, how can they get in touch?
So you can email me at Candace, CANDACE at astraeq.com, or you can also visit our website at astraeq.com. Find me on Facebook as well, Candace Pilgrim.
Awesome. Anything else that you wanted to share before we wrap up this call, Candace?
I don't think so. I would just say to anyone interested in getting started, just do it. Get out there and jump right in, because that's the only way you're going to learn.
Awesome. Well, thank you so much, Candace, for taking the time. And until next time, deal makers, talk to you all later. Hope you all enjoyed this episode. If you did, please go on over to iTunes and leave us a review, as that greatly supports the show. And if you'd like to be able to connect with John, the community, and I, then come and join us on our Facebook group, the Multifamily Success Network, where you can connect and make deals with other multifamily investors. Go to multifsuccess.com/community.